Hello, Professor Gimetti, dealing with lesson number 19. A quick review of the income statement. And I have that listed right here in the top corner. Sales minus expenses, which deal with both variable and fixed expenses, gives you EBIT, earnings before interest and taxes. Minus interest gives you earnings before taxes. Minus taxes gives you net income. Or if you're doing it on a per share scale, earnings per share. Okay? Now, think about this. When you have risk, business risk, what does that mean? That means that there's variability here because of sales, because of variable costs, or because of fixed costs. Okay? Usually per unit, sales and variable costs stay the same. So with increases in sales, assuming that that is still true, the more units that you sell, the less per unit are your fixed costs. Okay, so for instance, if you've got fixed costs of $10,000, I don't care what you sell. If you only sell one unit, you're going to have, $10,000 per unit of fixed costs per unit. If you sell 10,000 units though, then your fixed cost per unit is only $1. So the more units you sell, the lower your fixed cost per unit. Okay? So that has a big impact because if you've got a lot of sales, all right, then you have less risk because you're covering those fixed costs with something. Okay? Now, we can talk about the degree of operating leverage. What that really relates to are your fixed costs. Okay? Because if you take the change in EBIT, in other words, you take one point in time this year and maybe next year, and you look at your earnings before interest and taxes and how much percentage they changed versus the percent change in sales. Okay? Because sales and variable costs are the same per unit, it's the fixed costs that are going to change that EBIT in percentage terms. So therefore, your degree of operating leverage hinges on fixed costs. Okay? The degree of financial leverage deals with your interest rate, your interest that you're paying, interest expense. Your degree of financial leverage shows the change here in earnings per share versus the change in EBIT. So it deals with this area only. Doesn't deal with this so much. It deals with this over two different time periods. So what's going to change that? Well, interest will. We assume that your taxes are a flat rate, 25%, 40%, whatever the rate may be. That isn't going to change proportionally, but it's your interest expense. Changes in interest expense, obviously that is more or less a fixed number. If you take out a $100,000 loan, okay, at 10%, you're going to pay $10,000 of interest. Now, how is that going to be less onerous on the business? Well, if you do more sales, okay, if you have more EBIT, then you have more to pay that interest with. Okay, and the taxes simply is a fixed, it's a constant percentage. So this interest is almost like a fixed expense, okay, except that it's below the line, below the EBIT line, okay. And then of course we have combined leverage, which deals with the entire thing, change in sales relative to the change in earnings per share, okay. This is just a general overview. I will give a lesson with some examples on degree of operating leverage, degree of financial leverage, and degree of combined leverage. Okay? Thank you very much.